Hello and welcome to the Daily Brief Show by Zerodha. Here we cut through the noise and bring you the most important stories that move the markets. Today is Tuesday, the 20th of August, and I'm your host Anurag Bansal. In today's episode, we'll talk about three big stories. In the first story, we'll talk about RBI's new norms regarding P2P lending. In the second story, we'll talk about the skyrocketing prices of coffee. And in the third story, we'll talk about the social stock exchange. So let's begin. See, if you want to borrow money, you can either go to a bank or borrow from non-bank lenders or fintech platforms that indirectly rely on banks and NBFCs. But for a various amount of reasons, you may not get a loan from them. It could be because you don't have a credit history, or it is low because of temporary issues you may be having. So what is the alternative in this case? See, typically people have relied on informal options like money lenders. But the issue here is that they charge exorbitant rates of interest. But what if there was a lender that fell somewhere between banks and money lenders? Well, that is where peer-to-peer lending platforms come in. See, peer-to-peer lending platforms connect to a borrower to a lender. Think of it as an Amazon or a Flipkart, but just for loans. On one side, there are people who want to lend money because they expect to make returns a little higher than fixed deposits, but are not willing to take the risk of investing in equities. And on the other side, there are people who are not able to get loans from banks for a variety of reasons. In the middle is peer-to-peer lending platforms that connect both of these. See, peer-to-peer lending or P2P lending has existed for as long as money has been around. But the first P2P platform started in the US during the 2000 dot-com bubble. In India, some of these platforms have been around since 2012, but they were largely unregulated. In 2017, the RBI created a new category of non-banking financial companies called NBFC P2P, and they've been regulated ever since then. The first P2P platforms did what the name implies exactly. They connected lenders and borrowers. But this largely did not work out because of issues ranging from the inability of lenders to screen borrowers, adverse selections on the platform side, high defaults, and also the cumbersome nature of lending multiple times. Because of these issues, P2P never really took off in India and platforms stumbled for a bit. But some P2P platforms figured out innovative ways to solve this problem. First, instead of letting lenders pick individual borrowers, the platform automatically split the money lent by the borrower among multiple borrowers. Users still could choose the borrowers, but letting the platform do so was easier. This diversification largely reduced the risk of defaults. Second, some platforms also allowed the lenders to sell their loans before the full term of the loan by creating a secondary marketplace of sorts, just like stocks. Third, some platforms even offered to cover the risk of defaults from the fees they made, that is the difference between the lending rate and the borrowing rate. Fourth, because of the first two developments, P2P became less risky and it was marketed as an investment option that offered better returns than fixed deposits and bonds. Directly or indirectly, some platforms made it seem like the returns were guaranteed also. But on August 16, the RBI issued new guidelines that threatened to put an end to most of these practices. Let me quickly explain what the new RBI guidelines say. First, they say that P2P platforms cannot provide any credit guarantees to enhancements. This means they cannot tell the lenders that the platform will cover or insure their losses. If lenders lose money, then they have to take the hit. Second, in the earlier model, if you as a lender invested 1 lakh rupees, the platform would automatically split the loan amongst hundreds of borrowers. This required just one authorization, but now the RBI says that every loan has to be approved and an agreement has to be signed. This means hundreds of OTPs, e-signs, etc. The diversification benefits the platform provided breaks. Third, as soon as the lender transfers the money, the platform has to send the money to the borrower in T+1 days, or else it has to send the money back to the lender. Fourth, P2P platforms also cannot promote peer-to-peer lending as an investment product with features like tenure-linked assured minimum returns, liquidity options, etc. Now, as you can imagine, these are some mega changes and they are bound to significantly impact the volumes. More importantly, the business impact can be reputational. So will lenders think that RBI is imposing actions because there is something wrong with the platforms and they will stop trusting P2P? Why is RBI making these changes? Now we can't know the real reason, but here is the best guess. First, the RBI governor on multiple occasions has said in the past that banks are losing deposits to other investment options. So the question is the RBI worried that P2P has become more attractive than bank fixed deposits? Second, was the RBI concerned that P2P was promoted as an investment with assured returns, even though P2P platforms are lenders and not investment management companies? Third, P2P loans were also sold by a lot of mutual fund distributors. Was there some communication between SEBI and RBI? See, like I said, I don't know answers to these. Only time will tell. In their defense, though, P2P platforms have said that they were always subject to RBI audits and the RBI knew all their business models very clearly. They were transparent about how they function. They also say that by offering an option to diversify among loans, offering flexible performance based fee structure, etc., they were offering a better structure to lenders. Because if lenders do one-to-one lending, they are exposed to 100% of the risk. But all in all, this is a significant challenge to the industry, and it remains to be seen how the industry will do going forward. Moving on to the second story for the day, did you know more than 10 billion kgs of coffee was consumed across the world in just the year 2023? Coffee, in a way, is the fuel that makes the world go around. Can you imagine starting your day without a cup of coffee? I definitely can't. But the coffee that you and I drink today might get pricier because coffee prices have been shooting up because of bad weather, shipping issues, regulatory issues, and other factors. I'll get to that, but let me put some numbers before that. As of this recording, Robusta coffee futures that trade in London were trading at 4,500 to 4,700 US dollars. Prices have risen by 60% year to date. Now, this is really crazy because these prices are almost double of what was considered very high just 1 year back, and this is happening due to 4 main reasons. First, weather. See, adverse weather patterns have severely affected coffee production in Vietnam, which is the second largest producer of coffee. Now, even though Vietnamese coffee output was only about 5% below expectations, the problem is that this comes in the wake of disappointing harvest in Brazil in the previous years. The market still has not adjusted to the demand-supply imbalances due to these volatile harvests. The second reason is shipping delays. See, if you've been following this show for a while now, you might remember the story in which I discussed the ongoing shipping crisis in the world. In a nutshell, world trade has been affected due to conflicts in the Red Sea region, which is a critical ocean way that connects Asia and Europe. Conflicts in the Middle East are forcing ships to take a longer route around Africa. This has disrupted global trade, and coffee is absolutely no exception. The third reason is regulatory concerns. See, the European Union has recently passed a regulation to ensure that products imported into the European Union have not contributed to deforestation. This regulation will come into effect by the end of 2024. Now, because of this, coffee farmers must now show that they have not contributed to deforestation, and proving this is not an easy task for sure. Farmers sometimes have to clear trees, etc. to grow coffee, but that does not mean that they are willingly causing deforestation. To avoid this, they must replace the tree cover lost due to coffee plantations, in which case they will be able to comply with the regulations. But as you can very well imagine, this is much easier said than done. Now, this greatly affects the global coffee market because the European Union imports about 30% of the world's coffee. The fourth reason is market dynamics. See, in 2021, Brazil, which is the world's biggest coffee producer, experienced a severe drought. This drought was followed by the worst frost in 27 years in Brazil. Coffee fields across the country were covered with ice, and estimates suggest that Brazil lost about 20% of its coffee production that particular year. If you add the disruption due to COVID-19, things were really bad for coffee importers across the world. Now, there are mainly two types of coffee grown worldwide. First is Arabica and second is Robusta. The more common breed grown in Brazil is Arabica coffee, which is important because Brazil produces 40% of the world's overall coffee. The 2021 crisis in Brazil led to some large buyers shifting to Robusta coffee instead of Arabica due to better availability and relatively lower prices. Now today, even though Arabica harvests have recovered in Brazil, buyers have not completely shifted back to Arabica. This is probably because they are worried about another repeat of the 2021 disaster and they don't quite want to put all their eggs in one basket. Now, due to all these factors, experts are suggesting that coffee prices will remain volatile for the rest of the year 2024. A recovery is expected in 2025 because of the hope of a great harvest in Brazil. But the unpredictability of climate change induced disasters and the 2021 Brazil incident would keep this market very sensitive to news and weather forecasts for a really long time. Moving on to the next story of the day, we'll talk about SSE or the Social Stock Exchange. See, at some point in your life, I'm sure you would have made a donation to an organization that helps uplift the underprivileged. Whether it's back in school or college, At workplaces or just separately, most of us have made a donation in some capacity in the past. Now, while it is a noble cause, usually the biggest concern is legitimacy, which is whether or not your money will really be used in the right direction. Then there is also the issue of knowing whether a charitable organization is credible or not. This is one of the biggest reasons why social organizations have a tough time raising funds. There is also the fact that India is a poor country and we have humongous problems, and not all of them can be solved by the government. You need others like wealthy individuals, private organizations, and other social organizations to fill these gaps. So, to solve some of the problems social organizations faced, a platform called the Social Stock Exchange was created under the regulatory guidance of SEBI. Essentially, the SSE acts as a bridge between donors and organizations doing legitimate social work. The Finance Minister Nirmala Sitharaman first proposed this concept in the 2019 Union Budget. In 2023, the SSE became operational. In about 1 year since its launch, about 10 social organizations have listed themselves on SSE and have raised capital in the range of 1 to 2 crores each. But recently, a non-profit organization called Swadesh raised 10 crore rupees alone via SSE. Swadesh is run by Ronnie Screwvala, who is popularly known for founding the edtech startup Upgrind. This is a big deal because it makes Swadesh's 10 crore the biggest capital raised by far on the social stock exchange. Over 150 individuals across different industries participated in this. This includes popular names like Infosys co-founder Nandan Nilekani, former HDFC chairman Deepak Parekh, and Mahindra Group chairman Anand Mahindra. With some big names showing confidence in the SSE, this could hopefully become the preferred means for smaller investors also to donate money to social welfare organizations in a more credible manner. By the way, to support this cause, we at Zerodha have also invested about 4.5 crores in 7 organizations through SSE. That's all the news I have for you today. I hope you found value in today's episode. I'll see you tomorrow. Take care and goodbye.